The trade that damages you most is not always the one that loses money. Sometimes it is the one that teaches you to distrust your own judgment, to flinch at the next clean setup, or to chase a poor one, simply because you cannot bear the silence after being wrong. That is the hidden cost most traders pay without entering it in their ledger. The market takes the money first, then waits to see whether you will offer it your composure as well. There is a strange paradox in trading. The more urgently you need the market to speak, the less clearly you can hear it. A chart does not become more honest because you stare at it harder. A position does not become more intelligent because you defend it with emotion. When you are unsettled, every tick begins to carry a message it never intended to send. A small pullback becomes betrayal. A normal pause becomes danger. A sudden move in your favor becomes permission to abandon discipline. This is where the quiet work begins. Emotional resilience in trading is not the ability to feel nothing. That is a fantasy, and a dangerous one. The disciplined trader still feels pressure, doubt, regret, impatience, and the sting of being wrong. The difference is that he does not let those feelings issue orders. He learns to observe them the way he observes volume, range, failed breakouts, and hesitation near a prior high. He does not ask, "How do I stop feeling this?" He asks, "What is this feeling trying to make me do?" That question alone can save a trader from many unnecessary losses. When fear appears after a planned entry, it often urges you to cut too soon. When pride appears after a losing trade, it often urges you to enter before the market has repaired itself. When boredom appears during a quiet session, it whispers that activity is the same as opportunity. It is not. Some of the most expensive trades begin not with conviction, but with restlessness disguised as analysis. You must learn to recognize the difference between market movement and personal agitation. The market may be moving, but that does not mean it is offering you an advantage. Price may be active, but activity alone is not a signal. A crowd can be excited and still be wrong. A breakout can look impressive and still lack commitment. A decline can look frightening and still be nothing more than the market testing weak hands. So before you decide what the market is saying, notice what you are bringing to it. Are you reading price, or are you searching for relief? Are you following your plan, or are you trying to erase the last mistake? Are you waiting because patience is required, or because you are afraid to act when your conditions are present? These distinctions matter because every trading decision has two sources: the condition of the market and the condition of the trader. When the trader is unstable, he will misread even a good market. When the trader is quiet, he may see a poor market clearly enough to leave it alone. That is where the deeper lesson begins. Silence is not emptiness in trading. It is the place where motive becomes visible and where the next decision is either strengthened or corrupted before the order is ever placed. The most dangerous moment in your trading day may come after the trade is already closed. Not before the entry, not while price is moving against you. Afterward, when the loss is booked, the chart is still open, and nothing in the room has changed except the way you feel about yourself. That is when silence becomes uncomfortable. A losing trade has a clean financial meaning. You risked a certain amount, the market disagreed, and the position was closed. But inside the trader, the loss often becomes something larger. It becomes a judgment. It becomes an accusation. It says, "You should have known." It says, "You gave back what you earned." It says, "Now you must fix this." The market did not say those things. Your disturbed mind did. This is the first lesson in emotional resilience. A loss does not have to become a command. When a trader is calm, a losing trade is information. It tells him that this particular idea did not work under these particular conditions. But when he is unsettled, the same loss becomes pressure. It pushes him toward action. He starts looking at the next candle not as evidence, but as an opportunity to feel whole again. The chart has not improved. His need has increased. That difference matters. After being wrong, your mind wants relief more than accuracy. It wants to remove the sting. It wants to prove that the loss was temporary, that your judgment is still sharp. That control has returned. This is why the next trade after a loss is so often lower in quality. The trader is not selecting it from strength. He is selecting it from discomfort. And discomfort is a poor analyst. You must learn to recognize the emotional residue of being wrong. It has a signature. You may feel an urge to enter faster than usual. You may widen your attention and suddenly see setups everywhere. You may reduce your standards and call it flexibility. You may become overly cautious and refuse a valid trade because the previous one hurt. These reactions look different on the surface, but they come from the same source. The loss is still trading through you. This is why silence after a loss is not empty time. It is a test of whether you are still fit to make decisions. The market does not care that you are trying to recover. It does not reward the trader who feels wrong. If anything, it becomes more dangerous to him because he begins to interpret ordinary movement as personal opportunity. A small bounce looks like a second chance. A quick drop looks like confirmation. A fast candle looks like rescue. In that condition, price no longer has to deceive you. You deceive yourself by needing too much from it. So the first practical step is not to promise that you will never feel emotion. That promise will fail. The practical step is to separate the closed trade from the next decision. After a loss, pause long enough to ask one simple question: am I looking for a trade or am I looking for relief? Do not answer too quickly. Look at your body. Look at your pace. Look at how badly you want the next setup to appear. If your breathing has shortened, if your hand is ready before your plan is clear, if you feel insulted by the market, then you are not observing anymore. You are reacting. And a reacting trader is easy for the market to punish because he has become predictable. This does not mean you must stop trading for the day after every loss. That would be too simple, and trading is rarely improved by rigid gestures that do not understand context. It means the next trade must earn its place independently. It must meet the same standard it would have met if the previous trade had never existed. If it cannot stand alone, it is not a trade. It is an emotional repayment plan. The disciplined trader protects the space between loss and action. He knows that one loss is ordinary, but one loss followed by emotional urgency can become the beginning of a poor sequence. The damage compounds not because the market moves, but because the trader carries disturbance from one decision into the next. So before resilience can show itself in the large moments, it must appear here, in this narrow silence after being wrong. Not in speeches, not in confidence, in the refusal to let pain choose the next order. And once that space is protected, the next problem becomes sharper. Even when your mind is quiet, the order itself must be prepared before pressure arrives. A trader often believes his weakness is fear, when the real weakness is that he waits too long to decide. He stands in front of the chart with only a rough idea of what he wants, and then expects clarity to arrive at the exact moment price begins to move. That is a hard way to trade. The market does not slow down so a trader can gather himself. Execution fails when the decision is still unfinished. Before the order is placed, everything appears simple. You can see the level. You can explain the idea. You can say where price should not go if the trade is wrong. But once the market comes near your entry, the atmosphere changes. The candles move faster. The spread may widen. The hand becomes less steady. Suddenly the trader, who sounded certain a few minutes ago, begins adjusting, doubting, bargaining, and waiting for one more sign. That delay is not always caution. Often it is unpreparedness revealing itself. A clean execution is not born at the trigger. It is born before the trigger. The trader must know what must happen, where it must happen, how much he is willing to risk, and what would prove the idea unfit. If these matters are still open when price arrives, emotion will enter the vacant space. It will offer reasons to chase. It will offer reasons to hesitate. It will make the same setup look urgent one second and dangerous the next. This is why the order must be prepared before pressure arrives. The market gives very little mercy to vague intention. A trader who says, "I will see how it looks," often ends up seeing whatever his nerves allow him to see. If price moves quickly without him, he may enter late because he cannot bear to miss it. If price pauses near his level, he may abandon the idea because the pause feels like warning. In both cases, the market did not change his plan. The absence of a plan changed his behavior. You do not need to predict every movement. You need to remove unnecessary decisions from the moment of action. There is a difference between watching price and negotiating with price. Watching means you are waiting for defined conditions. Negotiating means you are changing your requirements because the live movement has stirred you. The first is execution. The second is improvisation under stress. Some traders call it instinct, but instinct without preparation is often just emotion wearing a confident face. So before the market reaches the area that matters, your work must already be specific. Not, I like this trade. That is too weak. You must know, if price reaches this area and behaves in this way, I enter. If it does not, I do nothing. If I enter, my risk is fixed. If the trade is invalidated, I exit. If the move runs without giving my condition, I let it go. That last part is important. A trader who is not prepared to miss a trade is not prepared to execute one. The purpose of this preparation is not to become mechanical in a lifeless way. It is to protect judgment from the heat of the moment. When the market is closed, or when price is still away from your level, your mind can judge with more balance. You can think in terms of risk, structure, and conditions. But when price is moving and the opportunity appears immediate, the mind begins to care about being included. It wants participation. It wants proof that it saw the move. That desire can turn a planned trade into a poor entry. Your task is to give the live market fewer chances to influence your standards. This means writing the trade before taking the trade, even if only in simple terms. The level, the trigger, the risk, the reason for invalidation, the reason to stand aside. Once those are clear, execution becomes less dramatic. You are no longer asking the candle for permission to think. You are checking whether reality has matched your conditions. And if it has not, silence is the correct order. The disciplined trader understands that restraint is also execution. Not clicking is not failure when the conditions are absent. Waiting is not weakness when the plan has not been triggered. The quiet trader is not slow. He has already decided where decision is possible and patient where the market must still speak. But even perfect execution cannot remove the uneven nature of results, because the next lesson is harder. A well-executed trade can still lose, and the trader must understand why that is not a contradiction. A trader can execute well and still lose. This sounds simple until it happens 3 times in a row. Then the mind begins to argue with the numbers. It starts asking whether the method is broken, whether the trader has lost his feel, whether the market has changed beyond recognition. But often, nothing extraordinary has happened. The trader has simply met the part of probability he hoped to avoid. This is where many traders suffer unnecessarily. They accept risk in theory, but they expect fairness in sequence. They understand that losses are part of trading, but they quietly want those losses to arrive in a neat and respectful order. 1 loss, then a win. 2 losses, then a larger win. A clean balance that keeps the mind comfortable. The market does not arrange outcomes for emotional convenience. It distributes them without concern for how ready you feel. That is why emotional resilience must have a mathematical foundation. If your method has an edge, that edge does not appear on every trade. It appears over a series. A single trade is too small to prove much. 2 or 3 trades are still too small. Even a short losing streak may say very little about the quality of your approach. But to the untrained mind, each outcome feels personal and immediate. It treats every loss as evidence and every win as confirmation. This is dangerous because it makes your confidence rise and fall on samples too small to deserve that power. A trader who does not understand distribution will keep judging a long-term process by short-term noise. Consider what happens when you expect each trade to validate you. A winner makes you feel correct, so you may become too relaxed. A loser makes you feel exposed, so you may become too doubtful. The system has not changed, but your belief in it has changed because the latest result took control of your interpretation. When this happens, you are no longer trading your edge. You are trading your reaction to the last outcome. The mathematics of trading is not there to make you cold. It is there to keep you sane. A valid approach can produce a cluster of losses. It can produce a profitable month with ugly days inside it. It can produce a good year with uncomfortable periods where nothing seems to work. This does not excuse poor trading. And it does not mean every drawdown should be ignored. But it does mean that discomfort alone is not evidence. The question is not, did this trade hurt? The question is this result still within the range my method can reasonably produce? That question changes the trader's posture. If you know your numbers, a loss no longer has unlimited meaning. It has a place. It belongs inside a range of possible outcomes. You can look at a losing streak and say, this is unpleasant, but not yet unusual. Or you can say, this has moved beyond normal expectation, and I need to review. Both responses are calmer than panic because both come from measurement rather than emotion. Without that measurement, every difficult period becomes a personal crisis. This is why you must know the basic character of your trading method. Not in vague terms. You need to understand how often it tends to win, how large the average win is compared with the average loss, how deep ordinary drawdowns can become, and how many trades are needed before judgment has any weight. These numbers will not remove uncertainty, but they will stop you from inventing meaning where there is only variance. A trader who expects variance is not shocked by it, and because he is not shocked, he is less likely to abandon sound behavior at the wrong time. The practical discipline is simple, but not easy. Stop asking one trade to explain your future. One trade cannot do that. A trade is one event inside a series. If you give it too much authority, it will disturb your judgment. If you place it correctly inside the larger count, it becomes information with limits. This is how silence becomes mathematical. You are not silent because you have nothing to feel. You are silent because the numbers have already taught you that outcomes arrive unevenly, and unevenness is not the same as failure. But once you understand that results come in irregular sequences, another question appears: what is the market doing during those quiet stretches before direction becomes clear? Price often moves before it is ready to travel. It lifts just enough to attract the impatient, drops just enough to frighten the weak, and pauses long enough to make both sides doubt what they saw. To the untrained eye, this looks like confusion. To the patient trader, it is often the market doing its necessary work before direction becomes plain. A market does not move cleanly simply because you have found a level. Before a true advance or decline, there is often a contest around that level. Buyers test whether sellers still have strength. Sellers test whether buyers are committed or merely hopeful. Orders gather. Stops accumulate. Early traders lean too far, and price begins to reveal who is acting from conviction and who is acting from impatience. This is why the quiet periods matter. A narrow range, a slow drift, or repeated failure near the same area may look useless if you only want action. But these moments often show the character of the market more honestly than the fast moves do. A sudden candle can be emotional. A sharp push can be a trap. But repeated behavior around an important area shows whether pressure is being absorbed, rejected, or exhausted. You must learn to watch the struggle, not just the breakout. When price pushes above a level and quickly falls back, the lesson is not merely that the breakout failed. The deeper lesson is that buyers were invited in and could not hold the ground. That failure leaves information behind. It tells you something about commitment. It shows whether the move had support beneath it, or whether it was built on urgency. A market that cannot hold higher prices after attracting buyers is speaking clearly, but only to the trader who is not eager to believe too soon. The same is true on the downside. A sharp drop may look dangerous, but if price refuses to continue lower, if selling pressure dries up, if each push down is met without panic, the market may be testing weakness rather than confirming it. The crowd sees danger. The quieter trader studies response. Did sellers gain control, or did they merely create a temporary disturbance? Did price accept the lower level, or did it reject it? These distinctions separate market reading from emotional interpretation. The market often uses movement to test participation. It moves to where orders are waiting. It reaches into areas where late buyers have placed stops, where short sellers are leaning, where breakout traders are eager, where fearful holders are ready to surrender. This is not personal. It is the structure of auction and pressure. Price goes where business can be done, and business is often found where traders are forced to act. So when you see a sudden move, Do not only ask, is this the direction? Ask what the move has accomplished. Has it brought in new buyers who are now trapped? Has it shaken out weak sellers before recovering? Has it cleared a level but failed to attract continuation? Has it moved quickly, yet left no evidence of acceptance? A move without acceptance is often only noise wearing the clothing of importance. The patient trader does not need every movement to become a signal. He watches how price behaves after the excitement. Does it hold? Does it continue? Does it return to the old range as if nothing important happened? Does volume or pace confirm urgency? Or does the market quiet down immediately after the crowd reacts? The answer is rarely found in the first burst. It is found in what follows. This is where silence becomes an advantage. While others are reacting to the first sign of motion, you are studying whether the market has actually changed state. A level that breaks and holds is different from a level that breaks and rejects. A pullback that finds support is different from a pullback that exposes weakness. A quiet range that tightens after absorption is different from a dead market with no interest. The market tests patience because impatience creates fuel. The early buyer, the late seller, the frightened holder, the trader chasing proof, all of them leave traces in price. Your job is not to join them automatically. Your job is to see what their behavior reveals. And once you can read that behavior without rushing to be part of it, the next question becomes unavoidable when the market finally presents evidence. How do you decide without needing certainty? The trader who needs certainty will always be late. He waits for the market to remove doubt, but the market never removes doubt without also removing some of the opportunity. By the time everything looks obvious, the cleaner decision has usually passed, and what remains is a choice made under pressure, not judgment. This is one of the quiet traps in trading. A trader says he is waiting for confirmation, but sometimes he is really waiting for comfort. He wants the chart to promise that pain will not follow. He wants the trade to feel safe before he accepts the risk. But a trade that feels safe is not necessarily a sound trade, and a sound trade will not always feel safe. The feeling of certainty is often a reward the market gives too late. So the question cannot be, am I sure? The better question is, are the required conditions present? This changes everything. Certainty asks the market to predict the outcome for you. Conditions ask whether the situation matches your standard for action. One is emotional. The other is procedural. One keeps searching for guarantees. The other accepts that a decision can be correct even when the result remains unknown. This is where disciplined judgment begins. A trader must learn to separate a good decision from a winning result. If you only call the decision good after it makes money, you will train yourself poorly. You will praise mistakes that happen to work, and you will distrust sound trades that simply failed. Over time, this confuses the mind. It teaches you to chase outcomes instead of respecting process. The market will not educate you cleanly unless you know what lesson you are asking from it. A condition-based trader defines the decision before the outcome arrives. He says, these facts must be present. This risk must be acceptable. This invalidation must be clear. This trade must belong to my method. If those requirements are met, he can act without needing to feel certain. If they are not met, he can stand aside without needing to prove he was wise. His authority comes from the standard, not from the result. This protects him from two common distortions. The first distortion is forcing a trade because the idea feels persuasive. The mind can build a fine story around almost any chart. It can explain why price should rise, why it should fall, why the crowd is trapped, why the move is early, why the hesitation is temporary. A story may sound intelligent and still fail as a decision. Conditions keep the trader honest because they demand evidence, not narration. The second distortion is refusing a trade because doubt is present. Doubt alone is not a reason to stand aside. In trading, doubt will often sit beside opportunity. The issue is not whether you feel doubt. The issue is whether the doubt has identified a missing condition. If it has, listen. If it has not, it may only be the ordinary discomfort of acting before the future is known. This is why every serious trader needs a decision filter. Before action, ask, what specific condition has appeared? What condition is still missing? What would make this trade invalid as an idea, not merely uncomfortable as an experience? What is the cost of being wrong, and is that cost acceptable before the result is known? These questions reduce the noise because they force the mind to deal with facts instead of appetite. You are not trying to become a trader who is always right. That ambition will make you brittle. You are trying to become a trader who can make clean decisions in the presence of uncertainty. There is strength in that. A clean decision can be reviewed. A vague decision can only be regretted. When the market offers evidence, do not ask it for certainty. It has none to give. Ask whether it has met your conditions. If it has, the decision belongs to you. If it has not, the silence belongs to you. But a trader cannot rely on clear thinking only when the moment arrives. The mind must be trained before the session begins, and that brings us to the quiet routines that protect judgment before the market has a chance to test it. A trader who begins the session unprepared has already given the market too much authority. He may not see it that way. He may think the day begins when the first price moves, when the chart comes alive, when the opportunity appears. But the market tests the trader before the first order is placed, because it meets him in whatever condition he brings to the screen. That condition is rarely accidental. A restless morning produces restless decisions. A scattered watch list produces scattered attention. A trader who has not marked the important areas will treat ordinary movement as discovery. A trader who has not reviewed his limits will negotiate with himself when pressure appears. What looks like poor discipline during the session often began as poor preparation before it. This is why professional habits matter. A routine is not meant to make trading feel ceremonial. It is meant to reduce the number of decisions that must be made under heat. When the session opens, the market brings speed, uncertainty, temptation, and noise. If you also bring unfinished preparation, you force your mind to build structure while emotion is rising. That is a poor bargain. Structure should be built in quiet conditions before the market has a chance to influence it. The disciplined trader does not ask the open market to organize him. Before the session, he narrows his field. He knows which instruments deserve attention and which do not. He knows the areas where business may become meaningful. He knows the conditions that would make the day active and the conditions that would make patience the better posture. This does not mean he predicts the day. It means he removes unnecessary surprise. Surprise is expensive when it comes from neglect. There is a kind of trader who opens the chart and begins searching immediately, as if opportunity will announce itself to the quickest eye. But speed without orientation usually creates confusion. Every movement competes for attention. Every candle seems possible. The mind becomes busy before it becomes accurate. A professional routine prevents this by deciding in advance where attention belongs. Attention is capital too. You can waste it before you lose money. You can spend it on marginal symbols, weak areas, unfinished ideas, and constant checking. By the time a real decision appears, the mind is already tired from chasing things that never deserved a decision. This is one reason traders break rules late in a session. They believe they lack discipline, but often they have simply exhausted their judgment through disorder. The quiet routine protects judgment by limiting exposure to unnecessary choice. A serious trader also reviews the prior session without drama, not to punish himself, not to celebrate himself. He looks for patterns in his conduct. Where did he follow his process? Where did he become careless? Where did he sit well? Where did he interfere? This review gives the day a lesson before the next day begins. Without it, mistakes do not become instruction. They remain habits with no name. You cannot correct what you refuse to record. The routine should be simple enough to repeat. Mark the important levels. Define the instruments in play. Know the planned areas of interest. Set the maximum risk for the day. Remove distractions. Review yesterday's conduct. State what kind of behavior would make the day a success, even before the profit or loss is known. These are plain acts, but plain acts repeated with seriousness become a wall between the trader and impulse. The point is not to become rigid. The point is to become prepared enough to remain calm when flexibility is required. A trader without structure confuses flexibility with wandering. A trader with structure can adapt because he knows what he is adapting from. This is the hidden strength of professional habits. They make discipline less dependent on mood. You do not need to feel sharp to begin correctly. You do not need to feel inspired to prepare correctly. You follow the routine because the routine carries part of the weight that emotion cannot be trusted to carry. And once the order is placed, that preparation faces its next examination, not in finding the trade, but in living with it while the market moves. Finding a trade can feel difficult, but holding a proper trade can be harder. Before entry, the idea is clean. After entry, the same idea begins to breathe, hesitate, pull back, and test your patience. The trader who felt calm outside the position often becomes a different man once his money is exposed. This is where management begins. An open trade creates a special kind of pressure because the result is no longer abstract. Every movement appears to add or subtract from your judgment. A small gain invites protection.